Good morning, traders. This is Brad Matheny. Today is I gotta look, the 14th of September. Yeah, I've been busy taking care of things this morning, but most importantly, what I wanted to do today, after some comments by members, I promised to produce a video showing you why I think it is different this time related to a potential market crash and why I do believe the markets are going to move into a vortex rally phase over the next 6 to 7 years, lasting probably till somewhere around 2031 to 2035. And I'm going to go through the data with you. I'm going to try to show you factually why I believe the markets are decoupling and that why I believe the markets may not move into a recoupling phase until after 2034 or 2035. So there's a number of real big reasons why this is taking place right now. And most predominantly, it is the generational cycle that has taken place. We have completed the end of the Strauss-Howe generational cycle. You could look it up. We're moving into a disruptive phase of the markets, and I believe COVID was the disruption of the markets, which is causing a decoupling of global markets to the U.S. based or mature economy based coupling phase that has been in place since essentially 1950s, 1960s. And I mean, I can show you how global growth has continued to expand for many decades. I mean, I was down in Southeast Asia in early 1990s, and we were talking about China and how China was going to explode. And all you've got to do is go take a Google search and look at China 1990 till now, and you'll see how much it has exploded. And this has happened across all, let's call it, resurgence economies throughout the world. China is just one example, but if you look in Southeast Asia and all across the Middle East, you're going to find that countries in the 80s that were struggling are now much more modernized. I mean, all you got to do is look at Qatar and Abu Dhabi and others. I mean, it's just an incredible growth phase, literally over the last 20 or 25 years, which has been built on credit. So now, before I get too busy talking about examples related to, what's going on in the world and how we can try to correlate, let's move on to these three simple slides, actually two. This is the title slide. You want to learn more about what I do, visit ment.com. It's really important you understand what's going on in the market, and I'm probably the only guy you're going to hear this from. I mean, there are hundreds of other people out there telling you the market's going to crash, the market's going to crash, the market's going to crash. Me, I'm telling you we're moving into a vortex rally phase, and the markets are going to double or triple over the next 5 to 7 years. So think about that. Why am I the guy that's telling you the markets will go up and double or triple when everybody else is saying the markets are going to go down? Well, maybe I understand things a little bit differently than other people, or maybe I'm just crazy. Who knows? But let's look at the data, because everything to me is data driven. I'm very logical about things, and I try to pick apart what causes the markets to move in certain ways. So let's take a look at it. So I'm going to show you examples on the chart. Slide number 2, 2008 and 2000 contraction events. The 2008 and 2000 contraction events were U.S.-based contraction events. You remember, we were post-dot-com bubble. We'd gone through a great rally phase while the rest of the world was still trying to catch up with, building technology and using technology. In 2000, I can tell you from my own experience, we were still talking about 286, 386 processors. Okay, we were barely getting into the early stage Celeron processors from Intel. And if you know anything about technology, you're probably laughing, thinking, oh, Celerons. Yeah, me too. I mean, that's back when we were talking about, single processors clocking in at probably, 1/50th of what current processors are capable of. So we've gone through a huge, massive global event with regards to technology that's proliferated throughout the world. Global markets reacted to these U.S.-centric events. That's, again, the primary focus I want you to remember is 2000 and 2008 were U.S.-based or U.S.-centric events. They were related to the 9/11 event and the dot-com event in 2000, and they were related to the U.S. housing and banking crisis in 2008. They were not global. It was a U.S. event, and the U.S. event came in and resolved itself relatively quickly. I mean, within a 2 or 3 year time frame, thanks to the Fed being very aggressive, lowering rates, and providing contingent events for the U.S. industries, banking, and others that needed it. Now, the Fed had not lowered rates, the Fed funds rate, prior to these events. In fact, the Fed had been raising rates prior to these events. So remember, we had moved ourselves into a fairly strong economy. Greenspan was raising rates into the 2000 and 2008 events. Now, we had Bernanke in 2008, if I remember right. And we had a totally different world. It was really U.S.-centric. Everybody was trying to couple to the mature U.S., Europe, and Japan economies. And so we were basically, watching global markets trying to rise up to compete with the U.S.-centric and major economies of the world. And again, I'm going to show you these events are totally different. The U.S. economy, or the global economy, was still coupling with the U.S. and other mature economies. Remember, I just stated that. They were still rising up to try to meet the demand of the U.S. consumer throughout all of these events, and really the disruptions that took place were U.S.-centric. They were more related to, the U.S. getting a crisis or credit event, and the global economies just kind of weathering through the 12, 18 months of that U.S.-centric based event. It wasn't a global event. And money supply functions disrupted after the collapse event. So understand that the Fed, by decreasing rates throughout these events, really disrupted money supply and continued to disrupt money supply for many, many years, particularly after the 2008 event. After the 2000 event, we recovered within a 3 to 4 year time frame, particularly because it was not a major crisis. I mean, yeah, the dot-com bubble was going to be a crisis, but 9/11 was a bigger crisis, in my opinion. So remember, the real issue here I want you to pick up is these are all U.S.-centric events, and then the Fed acted in a manner to try to stave off these crises, but really disrupted money supply immediately after the events by lowering interest rates. And that was going to be I'm going to show it to you in the charts. Now, look at 2020. 2020 COVID contraction event was a global event. This was something that was not U.S.-centric. It was global. It affected everybody. It came on very quickly. This was not one economy or two economies having some sort of a crisis event. This was the world having a crisis event. It disrupted supply. It disrupted manufacturing. It disrupted hard assets. It disrupted shipping. It disrupted oil demand. I mean, there was a massive, this is globally, not just the U.S., not just 1/10 or 1/20th or 1/25th of the economy. It was a much bigger event. It affected 99% of the global economy in some way, shape, or form. The Fed lowered interest rates instantly as soon as the lockdowns were announced. Okay, we should have had a crisis event if we were looking at one economy. We should have had some sort of unwinding disruption of the economy like we saw in 2000, 2008 when we had the Fed lower interest rates instantly. But again, this started a decoupling event. 2020 COVID started a global decoupling event where everybody dropped rates. Everybody became aggressively trying to spark an economy. After, 8, 9 years of trying to grow the economy after 2008, actually 12 years, let's call it, but really 10, 11 years. So what happened is the world acted in concert, lowering rates, locking down people, providing vaccines, trying to manage as best they could, and they all acted in concert after the event to try to spark a growth in the economy. Okay, totally different than 2000, 2008. Remember, the world reacted, yeah, to the U.S. market crisis in 2000 and 2008, but not in the same manner. I don't remember China dropping rates aggressively. I don't remember Europe dropping rates aggressively. I don't remember the world acting as they did after COVID. COVID is a true global event, which changed things and likely began a decoupling event that no one's really paying attention to. And then money supply functions began to disrupt in 2022 as the Fed raised interest rates. Remember, money supply functions began disrupting immediately after the 2000 and 2008 events, but they did not really begin to disrupt until 2022 in this case. And that is as the U.S. Fed began raising interest rates. This put a lot of pressure on the global carry trade. It put a lot of pressure on global capital markets and credit markets, and is still playing out right now. Okay, so now, give you some input. I don't believe the Fed is going to really make aggressive moves to lower interest rates until sometime late 2025. Yeah, we might see a quarter of a point decrease between now and mid or late 2025. But the Fed has acted very efficiently, in my opinion, and ultimately, yes, by 2027, maybe 2028, we might be looking back at, 3 or 3.5% Fed funds rate. But what the world is going to do. Remember, the world is trying to recouple back to the U.S. and the major markets right now, and they're struggling to do so. So let's go take a look at the data before I spend too much time telling you what's going on. You can see for yourself. So I've created these two charts. This chart highlights crude oil, gold, U.S. dollar, my custom money flow index, the SPY, and then we have the Fed funds rate down here. Now, the second chart I've created is this one, which highlights the Hang Seng Index, the NASDAQ 100, my custom U.S. dollar versus major currency index, my money flow index, same as the one on the other chart, the SPY, same as the one on the other chart, and the Fed funds rate as well. So what I want to highlight here is look at how the money flow contracted and moved. So we're going to try to draw this, right? So you can see we had this money flow moving higher and eventually contracting way down over here as we started to move into massive growth phase in the Hang Seng Index, world markets, and as we started to recover here with the NASDAQ. You can see we tried to recover here back up into this area. It's very narrow, but here's a good example. We started getting the contraction event as capital markets reflated. And again, that's kind of where we're at here, where we're seeing the capital markets reflate. But look what's going on with money flow. Not going to let me draw because I've got it there, so I'll drag it this way. Look at what's happening with money flow. Money flow is contracting. Has been since 2022. And this is a period where we're actually raising interest rates. Well, money flow contracting back over here was really at a time where we had lowered rates and then started to raise rates. Money flow contracting back over here was right after we had lowered rates in this area. This was the disruption area in actual market function that took place very aggressively after we dropped rates with the Fed. And you can see here, this is the U.S. currency versus major currencies. We've seen a massive decline in U.S. currency immediately after the event. We've seen a massive decline, a bit of a pop here, but a massive decline in currencies since the major event. Now, since COVID, what have we seen? Dollar is actually holding up and trying to move higher. What does that mean? How come we're not seeing these massive declines? How come we're not seeing these events? How come we're not seeing the Hang Seng Index move broadly higher? Where is that event? Why are we not seeing these same type of events? Why didn't we see the NASDAQ collapse? Why didn't we see it collapse like we saw over here, 60%? Why did it rally like a nut right over here? Why is the S&P rallying like crazy right over here, especially in the midst of rising interest rates? Well, what's going on? How come this is different? How come this area rolls downward, and here we get this massive expansion and then a moderate contraction in money flow while we're raising interest rates right over here? What's going on? We'll come back over here. Take a look at this. Here's crude oil. Crude oil collapses slightly after the 2000 event and then begins a very strong rally phase. Crude oil collapses, actually rallies here after the 2008 event, okay, which is likely because we had rallied into an extreme bubble phase after the Fed, but then we go through this extended contraction. Here we get a good solid rally after COVID because we're rebuilding global economies, and now we're contracting the downside. Gold didn't move higher aggressively over here. It took many years for gold to start to move higher. Gold did move aggressively through here, but peaked out back over here in 2011 and 12. Gold immediately started moving higher here. Why? Probably because it's a global event. What happened to the U.S. dollar? Dollar consolidated, contracted. Dollar consolidated and stayed flat. Dollar, in this case, contracted right after the event and has been rallying while other global currencies are much weaker. Okay, this is completely different. This is completely different. More so compared to this, I guess. You could say gold rallying here after this event. But again, crude oil reacted completely different. Reacted completely different. Okay, money flow is reacting completely different. Big rally after money flow after the COVID event, and now rolling downward. And like I said, the Fed funds rate here, we're seeing all of this rallying into a rising economy. Yeah, you can point out that, well, Brad, but it was rising back here too. Yeah, I get it. It was rising here, and oil was rising, and gold was rising. The dollar was collapsing and money flow was collapsing. What's going on here? S&P is rising. Fed has raised interest rates. We've now been almost 2 years at this interest rate level up here, moving higher. We're seeing the S&P move higher. We're seeing the money flow move downward. We're seeing the U.S. dollar hold up compared to collapsing over here. We're seeing gold move higher compared to the reaction we had back over here and this reaction here, which was very big. That's why I think gold is going up to about 9, 10, 11,000 or more. And look at crude oil. Crude oil recovered after COVID because we were behind on shipping. We needed to get the economy moving, and this was a big demand. Remember, crude oil went down to negative numbers over here. I mean, really wild. But we ended up recovering, and now we're weakening. What's going on? Why is it different? It's because it's a global event. And what's happening right now is the global economy is struggling to try to recouple like they were back over here. Remember, this is a great example of recoupling. U.S. market strengthens, Hang Seng strengthens. Remember, this back here, China was very early in their growth to be able to manufacture and export goods to the U.S. and to the world. By the time we moved to 2008, the Chinese market was pretty well established in their capability to export more materials and finished products and components to the U.S. and the world. So where are we now? What's going on right now? China has the capacity. China has the manufacturing. They have the ports. If the U.S. market is rallying like this and China is contracting like this while the U.S. dollar is holding up and strengthening and capital money flows have fallen. Now you got to remember, this is a huge amount. That's one of the things I think that's very important here. This is a huge contraction in capital money flows. We're looking at a, drag this, can't really see it. So let me expand this a little bit. We're looking at a 42%, get right on the number, a 38% contraction in money flow. Okay, come back over here and take a look at this contraction after 2008. We can actually go right from the peak here, which is right at the top, down to here. You're talking a 44% contraction in a zero interest rate environment. Okay, we're talking about from the contraction period here. We're talking about a, well, let's go all the way down to this low, the lowest low prior to this point, a 36% contraction. So here we have a 44% contraction, minus 44% in this money flow index while the S&P is rising and while we are getting a moderate supporting US dollar while crude oil is contracting. What is happening, guys? Ask yourself, what is happening? The U.S. market is supporting the global market, in my opinion. The U.S. market is rallying in the face of the Fed raising interest rates. We've seen inflation come down. We've seen hard assets continue to appreciate, whereas overseas hard assets are contracting quite aggressively, and rates are now starting to come down. Why? Because they're feeling the pain. They've decoupled from the U.S. and they're feeling the pain. In my opinion, once this moves into the low phase and starts rolling upward, which I think is going to be, and I want to move this here, I think is going to be more along the line of 2026 and 27, we're going to see the U.S. dollar continue to strengthen, maybe not quite that high. We're going to see the Chinese market base and bottom and begin to try to recouple out here. And we're going to see the Fed funds rate likely stay in this level up until probably 29, 30, and maybe move down to about 3 or 4%. I think what's happening here is you've got the U.S. markets leading a very unique flow of data. We've seen a contraction in money flow in the face of Fed funds rate moving higher. Never happened before. Absolutely never happened before. You could argue here, yeah, it did. The money flow did contract a bit here while the markets recovered through here and while we were raising interest rates leading to this peak. But we also had a complete collapse of the U.S. dollar and a strengthening global market. Okay, we don't have those anymore, do we? U.S. markets, U.S. dollar is holding up quite well. Hang Seng Index is collapsing. Okay, not quite the same. Really, not the same right here, because we're not seeing this decoupling event. What we're seeing is strength. Essentially, the NASDAQ is the leader. And the SPY is the leader. And we are likely going to continue to lead through the recoupling process, which I believe is going to start to really take shape out here in 31 to 35 or 36. Oops. Yeah, I didn't want to do that. So 28, 29. The recoupling event will be in this range here. But in my opinion, by the time we start recoupling, we are going to be looking in this area. I'll draw it right here. We're going to be looking in this area as a potential major collapse event. So I will draw this in purple. And I believe by the time the global markets attempt to recouple with the U.S. markets, we're going to be looking at what I'm calling the bot-com bubble. And I believe that's going to be the thing that very seriously disrupts the markets right around, I'll put it in here, right around 2030 to 2035. Essentially, that's what I think is going to happen. And see if I can set this up to center. I don't see a center. All right, whatever. No center. So we come back over here. We take a look at this data. Again, take a look at the oil. Oil has rallied higher and starting to contract. Where have we seen oil rally higher immediately after a crisis event and then start to contract? Yeah, you can argue right here. And gold was moving up. Gold is moving up. But the dollar was moving down. The dollar was moving down. Now the dollar's moving up. Totally different. Why is the dollar so strong here when we get the same similar setups back over here? Why are we seeing global money flow contract very aggressively while we're raising interest rates, where we're seeing global money flow contract in lower interest rates environments? It's because the U.S. market and the amount of money that's currently flowing through the world is essentially disrupting the global, how should I put it, alignment of global markets to U.S. markets. And what I believe is going to happen is the U.S. markets are going to continue to drive higher while the foreign markets continue to base and deal with their credit and debt concerns until a point in time, and I've shown you this over here, until a point in time where the global markets, and I will come back here, as I showed you right here, until a point in time where they find a base, they find a bottom, and I think it's going to probably be into this area, 2030, 2033, they start to find a base or a bottom, and then what will happen is they will start to roll out of this base or bottom, possibly contracting, and try to recouple right into the .com bubble. So remember, .com bubble is probably a U.S.-driven advancement in society and in manufacturing and industry around AI and robotics, leading to another kind of technology bubble very similar to 1999 .com bubble. But I believe that we're looking at 7 years of U.S. dominance, maybe more, before the global markets begin to start recovering and aligning, recoupling with the markets right in line for a massive market collapse. Right in this area, if I can shrink this down, regular, shrink this down, drag this over here, shrink it down even further. So if my research is correct, we're going to be looking at maybe a doubling or tripling of the markets, right? You've heard me say it. I've told you. No, we come here, we move up maybe into a tripling of the markets. And right about this time, while the global markets are starting to reconnect with this superheated U.S. economy, we're going to probably move into a big collapse event that's going to shake the markets and restructure the world. And then we will start another event over here, which I kind of believe will be, again, U.S. market and U.S. economy driven, because I believe this event will be substantial enough to not necessarily destroy, but really wreak havoc on global credit markets. I think that the global contraction here, without restructuring the shadow markets and the global debt issues going on, I think the global markets are going to be able to hold and try to pull through this without too much difficulty. But I believe when they start to recouple and rebuild here, in other words, they're going to start to see some upward growth, and they're going to get very aggressive with their credit market expansion and taking on new debt and trying to really ride this rally phase until it just collapses in this area and just collapses. And at that point, imagine you double down on a on a 4 at a blackjack table, and you're trying to double down thinking you're going to get one card that's going to get you to a winning hand, and then all of a sudden they hand you your next card and it's a 3, and you're sitting there with a 7, doubling down with a dealer showing an 8 and a face card down. You're doubling into it right here thinking you're recoupling while this event starts to unfold. And I believe that's what's likely going to happen. And at this point, the Fed will determine whether or not it needs to, but more than likely it will need to monitor rates through this contraction event, maybe moving back down into the 1 or 2 event. Now, this could be a .com bubble. It could be something else. It could be another, call it XYZ pandemic. Who knows? I don't know what this is. I think it's a .com bubble, but it could be coupled with some kind of a swine flu or bird flu or who knows, grasshopper flu. I don't know. But it's right in this area here that I believe we have the trouble. Until then, I think the rest of the markets are going to decouple. And yes, it is different. Why is it different? Because of this decoupling. It is because of this decoupling that we're seeing U.S. dollar strength, U.S. asset strength. And it is because of this decoupling that we are seeing gold continue to rally excessively. We are seeing the U.S. dollar build up and maintain above the 102, 103 area, even though we're a little lower right now. It is because of this that we're seeing oil struggle. It's because the global economies are not recovering as quickly and as efficiently as they did in the previous contraction events. And that is the real dynamic here. The U.S. market has the capacity and the money and the driving momentum to recover very quickly and persistently over the next 4 or 5 years, which is why I think we're going into a vortex rally. Whereas the global markets, they're struggling. In my opinion, they are struggling to maintain economic function after going excessively into debt while they're watching their capital markets and their consumer markets contract. So there you go. Why is it different? Come back here. It is different because the 2008 and 2000 contraction events were a coupling event and U.S.-centric events. The 2020 event was a global event that disrupted global markets in a way we've never seen. While we're at the end of a major generational cycle, this is going to take, in my opinion, about 20 to 30 years to work itself out and move back into a coupling, a real solid coupling event. That's why I'm telling you, this is the greatest opportunity of your lifetime. And if you get a chance, come over here, take a look at Mint.com and learn why my research is different than anybody else's and why you're going to get better research, better information, and better context for your trading right here with my Expert Growth membership. It's that simple, guys. I see things differently than other people. And again, you can do yourself a favor. You can continue to, let me drag this over here. You continue to try to sell into the markets. You know, go ahead. I know that everybody's telling you the markets are topping, the markets are crashing. Go ahead, sell. They've been telling you the markets are crashing since way back over here. Sell with everything you got. If you believe that the markets are really going to crash, and I'm telling you, you should be selling and mortgaging every blade of grass you've got to try to get into a short trade. But if you want something that's completely different and really going to give you some very clean, factually driven data, then come over to Mint.com and check it out. Okay? Remember, it's right here. Visit Mint.com. This is why it's different this time. And nobody sees this, apparently, but me. And now you. So, good luck, and I hope to see you over on my website. In the meantime, good luck. If you really think the market's going to crash, sell with everything you've got. And we'll see what happens.